nothing talks about it. Nothing talks about banking, lowercase b, like the movement of money in your life, the fundamental thing that's happening in your life for transactions to happen. Nothing addresses it. They all start with, okay, at the end of the order, pay yourself last. What's the marginal dollar? What are we going to do with that? That's where all the analysis starts. And some of them back up a little bit. And they're like, well, if we pay into like a retirement plan at this point in time, 401ks are the most predominant. But in a retirement plan, we skip the tax. So we could back up a little bit. But that's it. You're talking about the marginal money, not all of the cash flow.
Well, Joe, thank you for joining us on the Infinite Banking Initiative. Let's start off by hearing about your journey to discover the infinite banking concept.
First off, thank you for having me. It's an honor to be here. My journey began a long time ago. My dad was actually the first person to find this concept, but he told me the name of a book, and I could not remember it. So naturally, at the time, Barnes & Noble was pretty big around where I lived, and I spent a lot of time there reading in the personal finance section. And the only book I could find on banking was this one right here, Bank on Yourself. I read the book, but it wasn't the book he talked about. And in fact, when you get to the very end of the book, in the acknowledgments, the second person, Pamela thanks, is Nelson Nash for pioneering the actual underlying framework of her spin-off, I guess you could call it. So then I went looking for that book in Barnes & Noble, and I actually found a copy, and I went to try and buy it because I was running out of time, and it didn't come up in their register. Like they were scanning it, and it was like zero. Like, this isn't our book. I don't know how this got here. And and now I think maybe it was like a marketing tactic. They like staple their card in it and then stick it in different books. Well, I was like, can I have it for $10? Like, I'll give you $10 for it. And they're like, it's not in our, sure, $10. So I bought the book half price. So I felt like I won. But yeah, on the way home, I'm like thumbing through it. And I'm like, okay, it's pretty cool. It's got Bible verses. I'm Christian. This feels right. And then, a little bit later, I actually ended up reading the book. And I'm like, what is going on in this book? Of all the personal finance books I read, it's like, he's talking about grocery stores, airplanes. He's talking like, what is this? What is this guy talking about? I couldn't see it yet. I could not see the concept yet. I couldn't connect the dots. They were too far apart for me to actually see it. And side note, I think that's a big responsibility of an agent you're working with. Their job is to draw the dots for you, right? They're teaching like kind of almost a set curriculum, but they're trying to make it relative to you. Your job is to connect the dots, right? That's the catching part. The curriculum, his book is very durable. It's timeless. They're going to try and teach it to you at the pace you need to hear it. And you got to connect the dots with them. But if they go too quick or skip, they have really big dots and skip in between, you kind of get lost in this. Well, that's why I was lost. I'm like, I don't know what this is. So I put it back on the shelf and think Nelson Nash, a little crazy. I think my dad, I'm like, I don't know what this is. I'll keep it because it's my dad. But so fast forward a couple of years and I pick it up again and I read it again. And I'm still, at this point, I'm more like, but the S&P 500, but my Roth IRA, but, just a little bit background about me. I'm steeped in the modern financial planning world. So all this FINRA series you can think of, I am licensed for life, accident, health, property, casualty, but I didn't know it to this degree. So I have those under my belt, but I thought I knew it, but I didn't. Have the credentials, have lots of letters after my name, professional credentials. And I'm like, no, this is silly. Why would you ever do this? This doesn't make any sense at all. The rate of return over here is better. You can do so much more. You'll have so much more at the end if you do this. Just do this. Well, I don't know what the big deal is about. So I put it back on the shelf. Maybe a few years later, I pick it back up again because I'm like, I think at this point, I'm going through the CLU credential. I'm like, oh, wait a minute. Maybe there's a little more to this book. And I'm kind of, there's jargon in the CLU material, and I'm trying to pick what he's talking about in the stories and the analogies and all. And I'm seeing in the CLU material what he's actually talking about. I'm like, oh, but still, no, my Roth IRA would do way better than this. Why would I? It's a great story and a great way to talk about life insurance, but I mean, come on, who in their right mind would do that? So, fast forward a little bit longer. I decide I'm going to go out on my own. I was with one of the big four that shall remain nameless because they're the quiet company. And I go out on my own. And really, this book, the last time I'm reading it, it like hits me with 2x4 after 2x4 after 2x4. And it really connects because I had a deep understanding of planning now in modern financial planning, deep understanding of financial planning at a personal level, taxes, insurance now, and investments. And it's like this book wraps it all together. And when I start to see it, it's like, but the skies open up like, oh, it's like, wow, I took like nothing I've studied in the decade that I was in one of the big four companies talked about this, nothing. And I have a lot of experience and credentials and whatnot behind me. Nothing talks about it. Nothing talks about banking, lowercase b, like the movement of money in your life, the fundamental thing that's happening in your life for transactions to happen. Nothing addresses it. They all start with, okay, at the end of the order, pay yourself last. What's the marginal dollar? What are we going to do with that? That's where all the analysis starts. And some of them back up a little bit and they're like, well, if we pay into like a retirement plan, at this point in time, 401ks are the most predominant. But in a retirement plan, we skip the tax, so we could back up a little bit. But that's it. You're talking about the marginal money, not all of the cash flow. I don't have every edition, but I went out there. I'm like, I'm going to pick up the second and third, and I'm going to try and find all the editions and read and see if it's consistent. And he starts, at least in the second edition moving forward, he starts really talking about the concept with this idea that if some authority was able to spread all the wealth out to everyone, so everyone had the same money, everyone has the same opportunities, there's no barriers, what would happen in a few years? In a decade or so, it would revert right back to the disparity we have today. And it's like, why? Because 97% of people or 75% of people don't understand the flow of money. They don't understand money mechanics. The people that do have money flowing to them, the people that don't have money flowing through them and away from them. And man, that to sit there and in a moment, I'm kind of eating crow, right? I'm admitting everything that I learned for the first decade of my career, in-depth knowledge. It's like we skip that step. We totally skip the cash flow step.
That was my frustration also. Because, when Nelson published his book in 2000, we were in Birmingham, and I couldn't even read it because I get through the first 20 pages like, man, what is he talking about? And I didn't know anything about life insurance. I was an Army guy, so I didn't know anything about finance at all because, I knew I'd quote unquote retire with a pension. So, yeah, yay for me. And it's the same thing, but I approached it from just a totally novice perspective where you were a financial professional. And I think yours was a lot harder than mine journey because you had so much to, I don't want to say unlearn, but to look at it from a different perspective. Right. So I mean, so it took you like 5 or 6 years to actually for the light to go on. 10 years.
So in a way, I kind of relate this back in the Bible. Saul eventually named Paul. The 10-year gap that even Nelson mentions to get his head on screwed, like his head screwed on right. I feel like that was me. It was Pharisees of Pharisees. I legitimately will say I hated whole life insurance. In that career, hated it. despise it. At that moment, I'm eating crow and I'm like, it can't be whole life. Please don't let it be whole life. Could it be anything but whole life? But it was like, it's like, I think Becca Wilhite says it real nicely. It's like a small franchised banking business in a box. That's what the contract feels like. It has every element you would need to mechanically operate like a bank. It's all baked into the contract. Like receiving quote unquote deposit premium, but receiving deposits, making loans, policy loans, replenishing. It's like it's all there.
As a bank owner getting dividends, even though they're obviously different than any other kind of dividend. That's what Nelson said. This isn't a whole life insurance policy. This is a small business banking system, okay, with a death benefit thrown in on the side for good measure. If you understand what it's about and you want to maintain control of your cash flow.
That's such a good point. I think where I struggled in that 10 years, and where maybe a lot of folks in the what I call modern financial planning, started 1985 with the CFP board. When they came on the scene, it was actually from the insurance industry, collaborated to create that credential. And then it became this marketing almost machine to be the number one credential in personal finance. That moment is what I call modern financial planning, because it all changed. Before then, way back, like you can watch movies like there's a Christmas movie, A Wonderful Life. And in the movie, A Wonderful Life, they're talking about, well, do you have any stocks or bonds or cash value life insurance? Like that was a regular thing people did to store up capital. And somewhere in history, it just disappeared. Now, we could say that just coincidentally happened. There may have been people, directing that to happen. Yeah, I don't want to go down that rabbit trail, but yeah. So I believe it was deliberate, and it was pushed under the rug. And when you understand what's happening behind the scene a little bit more, you could see why that might be. But I think once you really struggle with that, the modern financial planning, to see this, it's a lot like a doctor that has a prescription, and the drug was developed for this purpose, but the side effect is over here that people notice. And then the more and more you use it, the side effect becomes actually the more primary reason to use it. So something like Ozempic for people became a weight control drug as opposed to its original purpose. It's like, that's kind of like whole life insurance. It was, yes, it's designed to pay a death benefit in a very, very efficient manner. But the off-label usage is this financing capacity that actually is more beneficial than just the death benefit. And Nelson proves that it's way more beneficial than just the death benefit.
If you know how to handle it, yeah.
Oh yeah. If you're using it properly, if you're being a good steward of your capital, you're restocking the shelves. You don't steal the peas, right? If you're repaying your loans, what that means. If you're capitalizing it properly, if you're paying premiums for as long as you can, for as much as you can, the family system gets bigger and bigger and bigger, more so than you would probably ever be able to get if you just went out and said, I'm going to buy a life insurance policy. And, maybe my wife will too, or maybe my kids will too. It pales in comparison to what can be done on a generational scale when this is implemented properly.
We talked about, why isn't whole life recognized as a viable alternative, much less the foundational financial asset, because the names that pop up in my mind are A.L. Williams, Ralph Nader, Urissa, and the key there is who got involved, the federal government, okay, and and Wall Street was happy to help out, and fix everything. So, but look what we ended up with. consolidation of money. It's outside of our hands somewhere else. So whatever. I don't want to sound like a revisionist, but there you go.
Well, one of Nelson's concepts here was that this is a solution that it's a grassroots solution. And everything you said, everything, like whether it's an IRA, a retirement plan, that's all top down. This is it's baked into this idea of freedom, autonomy. You get to decide what you're going to do. Nelson did not put in the book what to do with the can of peas. In the grocery store example, he talks about turning the can of peas, which is, it's a capital, it's the policy loan or replenishing. It doesn't say it has to create you have to bake a pie. It needs to be pea soup or a pot pie, or it doesn't tell you what it has to be. That's up to you to decide. This is just about the rotation of money in your life. Again, if it's not flowing to you, it's flowing through you to someone else. Whoever it's flowing to benefits. They get all the benefits. So this isn't going to make you rich in the sense that money's falling out of the sky. What it will do is like dollars aren't they're not terminal events. Like we think cash, when we pay cash, it's done. You paid cash and you forfeited the growth. So it's a cash flow, actually. So if you think of it in terms of a cash flow, the whole thing's about the flow. It starts to make a lot more sense that you want to control the flow in your life, as opposed to having it, the taxes, it goes this way, the bank interest goes that way. It's all flowing away from you, and you're left with this little tiny sliver, and hoping. Modern financial planning says we're going to take the marginal sliver and we're going to try and hope and put that in the market, give it to someone else in hopes that it grows to a really big pile. Then we can spend again in retirement, and then it's gone.
Yeah, we'll spend again and pay taxes on it.
Yeah.
At a quote unquote lower tax rate.
Yes, which
yuck.
Yuck. That's a funny. If you look at the IRS, the 16th Amendment, 1913, when it first came into existence, it was actually much, much lower and much more favorable to the average person. Today, even though we're at historical low rates, it's way more aggressive than it ever was. If you even just took the standard deduction from the very first 1040 you had to file, you took that standard deduction and said, well, okay, let's adjust that for your inflation all the way out to today. The standard deduction will be six figures, $150,000. It's 13 right now. They're pulling down the deductions and pushing up the rates. So the volume of money going to the IRS gets bigger and bigger each year. They have way more levers to pull. It's not just about the rate. It's not just about how it's how much money is escaping you. And that's in all avenues of your life, whether it's at a bank where you're paying interest, it's the volume that goes to the bank. Total volume. I don't care what they call it, a fee, interest, charge. Doesn't matter. It's leaving you. Taxes. It's the volume leaving you. I don't care if it's state tax or the federal tax or this tax or that. Doesn't matter. It's just leaving you. When you realize that that's the problem, it hits every dollar you've ever made. It's the whole flow you will ever make in your life. All has the same problem. It's being attacked.
Yeah. Well, Nelson says in the book that it's not, don't get concerned about rates, get concerned about the volume, interest. A perfect example is a mortgage. You end up, if you do a 30-year fix, you're going to pay more in interest in most cases than you were in principal. So whatever volume of interest is important, not the rate. Yeah.
His example in the book was a medical example. He used a syringe and said if a doctor were to push the plunger faster, would that change any of it? And the answer is no. But if they get the volume wrong, it doesn't treat the disease or it could kill the patient. If we take that a step further and say, well, what about there's a dosage, meaning there's a regimen you have to take the drug. If you needed 3 doses, but you only took 1, you still won't treat the disease, the ailment. But if you took 5 and you only needed 3, you could kill the patient. So we could see the priority he was lining up was frequency and volume are more important than rate or time even. So for people in the book, he talks about different ages of when to start. And we'll get lots of questions asking, am I too old to start? I'm in my 40s or my 50s or am I too old to start? Simple time, if you think about it, if we have enough volume and enough frequency, the time doesn't matter. Time and rate only matter in the modern financial planning world, where you're saying, here's $100. How long do I have to wait to make $1 million if I hope I get 6%? And they'll say, you got to wait 25 years. Well, I don't have 25 years. Well, if we change the volume to 1,000 or 10,000 or 100,000, we can very quickly see that grow. If we change the frequency and say, I'm going to put 100,000 and 100,000 and 100,000, we can get to 1 million very, very quickly. The reason to do this would be because you understand it's about cash flows and controlling the cash flow. By controlling the cash flow, it will create this death benefit. That's why I said it was on the side for good measure. Understand it's about the banking function first. In this particular usage, in his concept, it's about the banking function first. The process of banking, using specifically participating whole life insurance from a mutual company first. That will take care of the death benefit. You're going to spend money your entire life. If you use this, I call it the before asset. If the money goes here before it goes anywhere else, the rest will take care of itself. Right? It's not your money you shouldn't choose, right? It's to the policy or that purchase. We shouldn't split it and say it goes to the policy and that purchase. It goes here first, and then it does the things you want to do in your life, the major purchases in your life. That's straight from the book.
Well, Joe, tell us about that jump that you made from the traditional financial planning world into becoming a IBC practitioner. Tell us about that. How did that go? Do you still have some of the same clients? What were some of the challenges that you overcame and you're still working through now?
Well, yeah, I think the challenge is about order, I think. That's why I say it's the before asset. If you try and do this, do modern financial planning first, and then try and do this, you're backwards. They almost compete, and you'll almost feel this. Any advisor you'll feel is like, well, don't do that. Put it in the market. Don't do it's more of there's a tension there. But if you get the order right and say, well, this is going to be my financial heart, right? Instead of using a bank account, a credit card, a line of credit, and a loan, I'm going to use this for all financing and purchasing. This is going to be the financial heart. From here, then I can do, if I want a little disability insurance, or I want to go invest in the S&P 500, or buy a little business, or that order works. If this is first, if this is before the other, but if you put the other piece first, it combats each other. That took a while to learn, because I thought, as I grew, I thought it was just a piece of the puzzle, not realizing this is what you could say the material the puzzle is made out of. This is the foundation. Banking has happened since mankind has started trading for goods and services. It looks different. And even today, it looks different. If you go to Europe, they bank with euros. If you go to Japan, they bank with yen. In America, we use dollars. But we're all still banking. The banking function doesn't change. So in the future, could it be cryptocurrency, a Bitcoin and a Litecoin or whatever the coins come up? Sure. Those are the currency. That doesn't matter. The banking function will be the same. There's a flow. of some currency. It's got to be stored somewhere, right? It's got to be deployed and it's got to be replenished. This contract happens to be the premier place to do that while keeping you in control.
It's hard for people to start because, you know, they have to see the, you know, the what's important. It's not what's important when it comes to money flow. Number one. Number two is they have to see what problem it solves. You know, Nelson talks about the problem in one chapter in the book. But once they get it, they get it. But it introduces another aspect. Okay. It's a function of scale. If you want to attack all those problems, i.e. all your red numbers flowing away from you, most Americans can't start a policy big enough to transfer the banking function to a life insurance contract that they own. So it ends up being a series of policies. Do you see that also in your business?
Oh, absolutely. I think, and almost by design, because you would need such perfect foresight to see all the expenditures that will happen over your life, to be able to buy a policy today large enough it would provide the cash flows you would need when you needed it. It's a trigonometry equation on the fly that you can't actually pin down. So you're going to have a system. You could start big, you can start small, but it will be a system that will support your cash flow patterns over the course of your life. I think one thing you can look at any company, any mutual company, if you look at around year 20 in these illustrations, you'll notice that a dividend is large enough to pay the premium. Now, in modern financial planning, we might use that and just say, okay, look, you don't have to pay premium anymore. Well, I think Nelson's saying it takes 20 or so years to transition. If you think about the idea that all the money going into a policy, if we could just wave a magic wand and say, all the money going into a policy via paying premium can be returned because of the dividend. The dividend is big enough to do the same. So you could pay premium and then take the dividend cash, and net, it's the same. So in that moment, in theory, all of your cash flow could flow into a policy and you could still spend from your policy. But it takes a long time for a system of policies, or even one policy, to mature. So for the guarantees and the dividends to build up enough momentum to be able to spin off that type of income. So even I think it's a bigger question of you're not going to, excuse me, there's probably a limiting understanding if you're going to try and say, hey, I'm 30 years old. If I buy a policy today, you have no idea what your cash flows are going to look like for the rest of your life. It's impossible. You might be able to do for the next 5 years in one policy or 10 years in one policy, but you don't know if you're going to get promoted and then own a company one day and all of a sudden your income is 10 times what it was. Now your cash flows are 10 times bigger. There's an organic time to expand. And I think David, you were the one that created that sixth principle, make room for windfalls, or plan for windfalls. It's like a windfall doesn't have to be an inheritance. It's anytime your cash flow changes in a positive direction. You know, the kids leave for college and maybe go out on their own. In theory, you're never paying again, right? Well, there might be some amount of windfall you get from that. At least tuition's done, right? Maybe that's a windfall. But windfalls happen more common than you would think. You get a raise, that's a windfall. You get, equity, or you own a new company or buy a rental. There's a new tenant, there's a new client in your business. Those are all windfalls. So I think it's impossible to plan out the perfect policy in one shot. You're evolving with it. And I think that's part of the beauty of it. It's so flexible. It's such an easy The answer is so easy. Once you understand what's happening, you know what to do. It's like, oh, I have too much money. What should I do? Oh, well, why don't you store it somewhere?
Yeah, that's a good problem to have. But going back to real quick to the windfall things, like, we do have people who watch and listen to this podcast who are not well versed in IBC. So what are you talking about, windfall? Well, just think you're a NBA basketball player or NFL player, and you sign this massive contract and you got $20 million, and then 5 years later you're broke. Okay, so the theory there is when you're given an opportunity with all this money, no matter who you are, you're probably gonna blow it. Okay, you're probably gonna spend it. And then 5 years later, I had a $250,000 windfall from a house I sold. 5 years later, where did that money go? It just drifts away. Okay, so that's a windfall, 250. So how do you solve that problem? You dump it into a whole life insurance policy. When they dump it, quote unquote, you either start a new policy in the form of premium, or if you have a series of policies with outstanding policy loans, you fill up those loans, you pay back the insurance company with that $250,000. Okay, now it's gone. Okay, but guess what? Your policy structures are now loaded with cash surrender value. Okay. And so you still have control of that $250,000. So that's the difference. It's not gone forever. It's within your sphere of influence, your cash flow sphere. Okay, enough. There you go.
Oh, that's a good clarification. Yeah, it's as long as, and there's several ways to do that. I think starting a new policy, you mentioned one. I think if there's unpaid or underutilized PUA riders that you could pay up in your policies. I think some companies will allow you to pay a couple years of premium ahead, like they'll hold it in escrow for you. You could do that, and of course, whether it's strategic or not, loans, past taken loans, you can replenish. Yeah, you could. There's even So we had a client recently that there's an age gap of about, let's say, 10 years, and they're more senior, they're in retirement already, and the older person happens to be a male, which we're likely to pass away before our counterparts. So his death benefit, we're already planning a portion of that will pay the rest of her premiums. And each year we matched it up. So as the death benefit's going up, like it gets easier and easier to pay the remaining premium each successive year, which means the remainder is going to go to the kids, helping the kids set up their policies, which will receive grandma's or mom's policies and from grandma. So it's like planning for windfalls isn't just you, it's your family system. It's the whole system you can plan. It's a lot of fun when we get generational planning involved.
Well, yeah, that's I'm glad you brought that up. That's it speaks to my heart. Another aspect that a lot of folks who are getting involved with the whole life product and the IBC concept is, if you're a child or a grandchild and you receive a death benefit from a grandparent or whatever, the IBC solution is that's your seed money for you buying policies, and so again, that money doesn't get blown, spent, quote unquote, but it's seed money. So you start policies on yourself, your spouses, your children, or whatever, when you possibly don't have the resources to do that. If you're, in your 20s or 30s, now that gives you that boost to start the generational wealth growth for the successive generations coming after you. So it's perpetual if you understand the concept and you know how to use it.
Oh yeah, and I think you gave me two ideas there. The one, I'll explain this, kind of going back to cash flow, but staying with legacy. This idea that you have seed in your life, that's your cash flow. You have a choice. You can plant the seed for yourself and grow a tree and it has some fruit that has seed that you can plant that. And now there's multiple trees, and you can keep doing that. And the harvest gets more and more bountiful over time for all generations. Or you can give the seed away. And that's, most people are trained to give the seed away. Now, I don't mind whether you call that I pay cash. So I give a lot of seed in one shot, or I give a little bit of seed every month. That's debt. Or I put the seed over here, and then eventually I'm going to give the seed to somebody else. That's like saving in your 401k that eventually will get spent anyway. It's like none of those help you get the harvest for the generations. So we have a family farm that no one ever goes hungry. It's like, and I think your family is a really good example that it's, you don't use banks. You don't need the banks anymore. You don't need any of that because you already have the family farm established, and each generation is planting their seed in the family soil. I think when Nelson said in one of his principles, he says, don't do business with banks. The way I explain that is you want to shop home and you want to shop local. You want to shop with your family. So when you need financing, if your policy is only this big and you need this much, take your policy loan and then go maybe ask dad or brother or sister. Stay at home. Stay local. That makes your family farm bigger and bigger and bigger and bigger for all generations. It keeps that, like you said, perpetual. It keeps it perpetual. When you go to get your money, wherever you went to get it, it's got a return. Like there's a residence for that money. If you go to the bank, well, the cash flow, all the money's, all the profits, everything's going to the bank. If you go to your family farm, it all goes back to the family. One way, shape, or form, it's going back to the family.
Yeah, and you talked about seed and harvest. I don't want to dwell on taxes, but that, would you rather pay taxes on the seed or pay taxes on the harvest? Yeah, that's all I'm going to say about that. There you go.
Let's stay on the legacy piece of this for a second. Now I have an unofficial principle that I teach clients, and I try and teach people. It's not one of Nelson's, but if you bless this, then feel free to add this. But it's just share the blueprint. And I think if you look at what Nelson was doing, he was living that. His seminars, his book, the Institute, the practitioner program, he was sharing the blueprint. He shared it with you in hopes that you would share with your kids. They would share with their kids. They would share. If you don't transfer the wisdom, whether it's agent to client or client to junior client, and it gets lost. If someone receives a death benefit and they didn't know what David just said, that they should buy more insurance, plant the seed in the farm, they're just gonna go spend it. They're gonna buy a Ferrari. And it has that problem again. It's gone. It left the family farm. It's never coming back. Share the blueprint means coaching the next generation, bringing them up in this, because if you bring them up early enough, they'll never know what it's like to go to a bank and have to qualify for every single thing you want to do. And I just heard this, see if this gets your blood pressure up. So someone close to me was saying, their friend owns a gun shop. Someone went to purchase a handgun of some sort. They were using Apple Pay and got declined. And the person's like, well, not a chance, it's declined. So they called and they're like, no, you have the funds, that's fine. We do not support purchases at this institute, this type of institution. So it had nothing to do with whether they had the capital. They had no access to it in this transaction. And it's like, whoa, you think that's not coming? It's coming. You don't just like you don't want to be a partner. You don't want to have a silent partner that is the IRS. You don't want to have a silent partner that's the bank either. If they can pull the strings and tell you what you can and can't do, that will veer its head at some point that it's not going to be very advantageous for you.
I hadn't heard that before, but so I'll store that one down here for future reference. But yeah, it all comes back to, silent partners or anything with, the banking, central bank infrastructure, number one, and number two is the government. Okay, so you, in order to free yourself from that silent partnership, you need a private contract with a privately held company. Okay, and hopefully it's a unilateral contract, i.e., there's no stipulations on you once you sign it, except for paying premium. That's your only stipulation, right? So that's the grassroots solution. So, but it's again, just like you started this conversation, 95% of the American public doesn't realize it exists because they don't hear about it from the general media and even the social media. So, is it legit? Yes. Has it been around for 200 years? Yes. There used to be, every company used to be a mutual company. Every insurance company did. Now we're down to about, I don't know, 25 or something like that. They're mutual. So again, it's just too bad that the American public, and to lesser degree the Canadian public, has given up their ability to control their cash flow, for major expenses for their lifestyle. So, but guys like you were out there to help them out, right? And educate them.
We're trying.
Educate them and take care of them, and do it by example, not just by moving your mouth. So,
I think modern financial planning was this idea of personal finance is like the mirror image of corporate finance. Modern financial planning is very focused on your balance sheet. How big of a pile can we get? Corporate finance is very concerned with cash flow. Businesses run on cash flow. They monitor, they hawk their cash flow. Modern financial planning is how much my pile is in Roth, how much my pile is in traditional, how big can the pile get? Right? It's high risk, pay yourself last, high risk, no certainty. Ironically, corporate finance is all about cash flow. Pay yourself first. It's low to no risk. It's very calculated risk, and there's a lot of certainty there. It's like that's more in line with the infinite banking concept. It's all about cash flow. We don't want risk. Not on the foundational level. What are you, crazy? We don't need risk. We want certainty. We want simplicity. Like you said, it's a contract, a unilateral contract. And it's with a company, a mutual company, and that mutuality means they're sitting on the same side of the table. The decisions they're making are for the benefit of the owners, which also happen to be the customers, which is you and me. When we are, it's the only institution left that I know of anyway. It's a third party, but literally has to act in its best interest for you because you are the owner. Every other company out there, whether it's, a bank, for example, we'll just pick on the banks for a second. The banks have owners. The bank's job is to make profit for the owner, not the customer. You are where they get the profit from for the bank owner. This is the only relationship, that mutuality relationship, that allows you to sit on the same side of the table and enjoy the profits of the healthy business, well-run business behavior. I did want to take just a second to acknowledge, I think I wanted to share how I use this in my life, but for a second, I wanted to talk about something in the book that Nelson talked about when he discovered this, when he founded this. And in the book, he highlights that he was in some financial trouble, and there's a lot of debt mounting and from the real estate world, because leverage was the key to everything. It all turned on him, and then there were some illnesses in the family, and so he was getting like attacked from left and right. And in the book, he says he was on his knees, hands and knees, from 3 a.m. to 4 a.m. for months, praying, Lord, show me a way out of this. Like, God, show me a way out of this. And I think, I don't know enough people give the credit to that relationship. Him as a Christian is the reason he discovered this. Like the prophetic, we'll say he was allowed to see this. He didn't invent the contract, but he's the one that codified it so we could all see it too. He was like in the Bible, I'll say it's like in the story of Exodus, or the book of Exodus, Moses. He would be like the Moses character in this. He found it. He realized it. He codified it and revised it year after year after year, decade after decade. You have all those additions in the background, book after book after book, honing the message to make sure it said what it needs to say. I think giving him credit, and I think giving honor where it should be, like that's a prophetic, I think personally as a Christian, I think it's ordained. I think it was blessed for him to see this. Because if you were to try and say, let me put a whole bunch of PhD students in a room, and that's what's going to come out of it to solve the banking problems in the world, there's not a chance. And the more you like dive deep into the contract and how it works and the simplicity and the beauty of it, the more you would say no one could come up with this. How did this happen? But I just wanted to say that. And
that was beautiful. Thanks.
Yeah. For me personally, once I realized this, which I'll go back to remember I was hard-headed. I'm in the other world at this point. I'm half in, half out. Had a policy established the wrong way, not properly, loaded with some extra riders that I did not need, that did not help the situation, lower base than it should have been, but it worked. I paid the premium. The premium in a couple years built up to a subsizable amount that allowed me to start the company I have today. And I kind of want to say that for me, not just me, but if you're trying to find the perfect design, it doesn't exist. I promise you it doesn't exist. If you implement, you're going to be better off. Can we monitor that? And can we say different ways to implement based on your personal cash flows might be more efficient than others? Yes. That's the number. That's math though. There's a personal element and something I think Nelson spent a lot of time in is the behavioral side of things. If the best option is something you can't get your arms around and can't implement, it's not the best option. If you have to choose a mathematically inferior option, but it allows you to start, that's okay. Right? You're going to start and you'll build and the system will grow and it will be fine. Going back to the original thought where it was the biggest policy you possibly could, like there's no way to tell what's coming. The only thing to really be careful about is don't use all of your insurability. Like don't take that out of context, what I just said, and say, let's use all of my insurability because that's the only thing I can get my arms around right now. The people you're with should be able to coach you on how to use the policy, whatever design, to help you start to gain traction so you can wrap your arms and mind around the idea that paying premium is not a bad thing. The premium doesn't go away. All premium, PUA or base, will eventually be reflected in cash value. All of it. So now it's kind of like a timing thing. What frequency and what timing line up so we can match the cash flows to what we have available.
Yeah, everybody listening to this podcast knows that I'm Mr. Simple. And so, I keep things as simple as I can. And when I talk about premium, I talk about cash value, I talk about death benefit. Premium buys death benefit. Okay. And cash value must equal death benefit. Okay. Eventually it must equal it. So when you pay premium, you're buying cash value, you're buying death benefit. Of course, when you sign the contract, it says, okay, you paid this base premium, it's going to equal this death benefit. And, whenever the policy contract says it will. So if you want to increase your ability to leverage a policy for policy loans, then obviously a policy loan is based upon the collateral of the cash surrender value. So the more premium you can get into a policy, the more cash surrender value you have, and the more ability you have to use that as collateral. So it's not hard. Okay, there are nuances, and one of these days we'll talk about this in our podcast. We'll talk about the power of the base premium as it relates to the power of the paid up additions rider premium. Okay, how that relates to dividends, how that relates to cash value increase, and how that relates to ultimate efficiency in a policy over the course of the time of the policy. But I'm not an insurance guy. I'm not licensed to sell life insurance. I'm not contracted with any companies because I'm not licensed. But we use it, at least getting there on how to use this stuff. And you have to understand how to use it. And the question I always have every year is, okay, after I pay my base premium, how much PUA should I pay? Or is it more efficient to start another policy? Or is it more efficient to fill up, a hole somewhere in it? And there's no right and wrong answer, because as you suggested earlier, everything you do in life is, it depends. What's the best design? It depends. Okay, because all these policies are made in the same actuarial chassis. Every one of them, whether it be New York Life, Northwestern Mutual, Mass Mutual, Guardian, Security Mutual Life in New York. I'll go down and I'll talk about every mutual company on the planet out there. They're all based upon the same actuarial chassis. It's just a matter of what works best. In a lot of these companies, they think they know what works best, so that's how they design their policy options for clients. But the bottom line is, what works best for you, Joseph, what works best for me, or best for Lee, it's different, okay, based upon our goals and aspirations and how much we can afford. Like, I got a whole bunch of tiny little policies because I couldn't afford anything more than that. But hey, 20 years later, like you suggested, it's, they're beautiful. They're absolutely beautiful, because they go one way, and that's up. When I take up, I'm talking about the death benefit increases every year. Okay. And that's one thing that some of these pundits never talk about. They say whole life is terrible because the premiums are so high, relative to the death benefit. Well, how come my death benefit is twice as large as it was when the policy was issued? Tell me why that's the case, if you think it's such a lousy product. And we're not even talking about banking, right? We're not even talking about generational wealth transfer. We're not even talking about maintaining cash flow. We're just talking about just a product, which is not that critically important, as long as you understand how to use it properly, I think.
The one piece I would maybe add to that is, before you're trying to decide, I think an in-depth study of your cash flows, whether it's guided or self-reflection, where you're looking over your own cash flows to see, where is your money flowing right now? Where's it going right now? That will help inform you how the policy should fit into your world. Right? The policy it should be fitting into your cash flows. Right? It's not a piece of the puzzle where you just say, if I just put $5,000 towards this thing, what will it do for me? Like, you're using the wrong language. And that tells me you don't understand what you're actually doing here. Nelson had this story about his bypass, and he was describing this, and I kind of expanded on it and embellished a little bit just to drive the point home. But if you think about a financial problem here, you could say maybe that starts with you're feeling kind of funny. You go to the doctor, and what do? They look you up and down and say, you just need some blood thinner. Sorry. You come back and say, I don't know, it still feels kind of weird. And they're like, hey, you know what? You need to exercise more and diet more. And you come back like, man, I'm starting to feel pain. And they're like, oh goodness, you need a pacemaker. And then finally you come in like, no, I've been in pain for hours, like Nelson. What's going on? And they're like, oh my goodness, you'll be terminal if we don't do this operation. It's a quadruple bypass. You have 90% blockage in 4 arteries. And it's like that transplant is what we're doing here. We're taking the heart, the financial heart you currently have, your checking account, right? Your credit cards, your lines of credit, your loans. We're saying we're not going to do that anymore. We're going to do this instead, or as much of this as we can do. And that's going to be the quadruple bypass that fixes the situation, right? The 4 threats that I usually talk about are inflation, taxes, opportunity cost, the money flowing away from us because we have to choose between spending or compounding. We think we have to choose. We're told we have to choose between spending or compounding. And last, control. Those 4 things are leaking money out of our system. 90 to 95% of the money is leaking away because of those blockages. Where you transplant and bypass those problems, all of a sudden, the sense of peace, the sense of calm, the sense of like joy.
I talk to people about this and they say, "Well, I'm not in debt, so I don't need a system to manage cash flow." I said, "Well, okay, are you paying property taxes? Yeah. Are you paying income taxes? Yeah. Are you paying utilities? Yeah. Okay. What does that number look like when you add them all together? Well, this. Well, do you want to recapture that or not?" So you're in debt if that money's flowing the wrong way, if it's a red number instead of a green number. So it works for everybody. You just have to understand, like we started off way back when here today, cash flow. And you talk about business people, because they live and die by cash flow. And so most of the folks that we hear about that get it are business owners. They really do. Because again, they don't focus on that big number. And you see these commercials like, well, how much if you have saved $10 million, how long can you live on that in retirement? It's like, whoa, well, you're looking at the wrong thing there, man.
I was going to say that this is, to your point, this is for the average person. Read the book. He says it all, the average American. He says it's for the layman. So there's this movement, or I don't know what's out there, but it's acts like this is for the top tier of America, the top 0.0001%. Like Nelson proved this for the average person. Banking happens regardless, whether you have debt or not, whether you're a big investor or not. To your point, there's always cash flow, and it's either coming to you or it's going away. That's the crux of the problem. If it's flowing away, you're starving yourself of capital you otherwise have earned, you've paid the price for, that you should have control over, and your family should enjoy for as long as you could see into the future. Think long range.
Well, as we wrap up our time together today, will you please end by sharing what IBC means to you?
Autonomy. I think it's really rooted in control and freedom. I think it's it's this sense of peace. I think it allows for a greater tighter knit community within the family unit. I think it can, I don't know how you put it in a box, but I call modern financial planning operates in a hostile environment. This is like the friendly environment. This is like the peaceful environment. Once you start using it, it's really hard to go back and rationalize being treated the way you were the other way. As hard as it is to catch this and understand it and connect the dots, once you do, you can't unsee it. And there's no going back. There's no one in their right mind would willingly subject themselves to that and go back. But it's. I think if one word would probably be freedom.
Thanks so much. We really appreciate your time.
Enjoyed it, Joseph. Good catching up with you, man.